Hello, hello.
Hey,
Hey guys,
Trent.
Hey,
how's it going, everyone?
Just peachy.
There's Margaret.
How you doing, Mark?
Good.
Good. How are
I'm
you?
eating lunch.
Oh, that's good. How are the horses doing?
Well, my Tennessee Walker, I can now start riding again. He's got arthritis, and I give him
Mm-hmm.
a shot every other week. And I'm working with wild Mustangs. My next one, I'm going to adopt a wild one and train it. So,
Good.
oh
Good for
wow.
you. I
Wow.
had uh, I had 8 thoroughbreds at one time. I raced them. They were quite a handful.
yeah, I'm more get in the saddle and get in the woods kind of person. So,
So we could do that with these guys. They were just faster.
yeah, I let my horses go at whatever speed they want to go. I don't really care. I don't make them go galloping and running if they don't want to. So I'm pretty
Where,
laid back.
what part of the country are you in, Margaret?
I'm in Cincinnati, Ohio.
Oh, okay.
I thought you were in Canada for some reason.
No,
Is it Farmer
that's
Bob?
me.
Farmer Bob's in Canada.
Yeah, I think he is. Yep.
Yeah. Since there's a kind of a suburb of Cincinnati called Indian Hill that has 60 miles of dedicated horse trails that are absolutely spectacular.
Oh,
Nice.
wow.
They go in between. It's like the wealthiest suburb in Cincinnati. So they've made all these green spaces, and the trails have been there for like 100 years. They keep
Wow.
losing them because of development, but there's still incredible woods and creeks, and it's just spectacular.
Wow.
That sounds
Easy. I
like
don't
fun.
have.
I've had a lot of fun with horses in my life, and then that part of my life has moved on, and we've moved on to other things. So, but I had them for about 20 years and raced them. It was a lot of fun. The people around the horsing industry and business are always very helpful, and it's just a good group of people to be around.
Yeah, I love it. I particularly like this Mustang because most horses are trained with the pressure and release system,
Right?
and they're finding with the Mustangs that it's quite a number of them respond to connecting with humans.
Come here,
with this
Rover.
positive reinforcement. So I'm learning all about that now.
Well, I do have
Wow.
one I have a Mustang, but it's a '66 convertible. So
Right?
Oh
yeah,
God, I that's my dream car. When I got divorced, I had one in my garage for a month. He wanted to sell it to me for $10,000, and I just couldn't do it because everything was unstable then. I really
Oh,
regret
wow.
that.
whenever I take that out or put it in a car show or something, I spend the entire day listening to people's stories about. I used to have one. My dad used to have one. I dated someone who had one. We fit 8 people in those, and it just goes on and on. It's a whole day of people telling me stories about
Yeah.
their Mustangs.
That's
Yeah,
what
it's a
that my mom, I think it had a 64 convertible.
64 and a half.
Yeah. I think that was what's that?
Go ahead.
Anyways, that's what I grew up at her driving in Minnesota, Indiana, and eventually she sold it in Kentucky because the frame started to give. And I think to this day, I think she wishes she kept it.
That's what everybody says. They're happy.
Yeah.
The one that I have was my dad gave it to my mom. She always wanted a little red convertible, and this one was burgundy, and he bought it for $600 in 1972.
Oh,
And
wow.
and my mom, when I was driving it, I drove it when I was 15, and she said, "Well, when I'm done with this, you can have it." And when she passed away, that became mine. So it's been in the family since '72.
That's cool.
sweet.
Yeah. So we did keep ours. So I'm glad we did.
Yeah. It's awesome.
One I wish I had. I got an '84 Corvette. I had a Volkswagen Rabbit ordered, and I saw the new body style of the Corvette going down the road, and I switched, kept it until my son was 1 year old, and I'm driving a infant seat in a Corvette, and I just thought there's something wrong with this picture, so I sold that one.
Margaret,
so you got rid of the
Margaret, I don't
kid.
see anything wrong with that picture.
Right.
Well, I'm an
I think
ER
Bob would
doc, and
agree. Bob's got cars. He's a car enthusiast. So
That's interesting. I don't think I've ever seen a baby seat in a Corvette,
now,
I had one.
but that's interesting. Yes, I've had a lot of cars in my life, and what Mark was talking about, I go to a lot of shows. I'm a judge, And yeah, you can have stories all day long, you know.
Yeah,
So
Well,
crazy.
I'm gonna get started. This is our platinum channel, and usually people come a little later and they'll get on. Paul, who's one of our regulars, he DM'd me and said he'll be a little late, so he's going to come. And normally, I think Trent, you opened it up for anyone who wanted to come in this meeting.
Yeah, yeah.
Okay, which is cool. I'm down in South Beach, Florida, so I'm down in Trent's state, but not his area, in a nice windy, warm but very windy and kind of rainy weather down here. So I was gonna go outside and have the palm trees and make everyone jealous, but all the palm trees are like this way. So I decided to do it here in the room. We normally with Platinum Channel is, we really focus on market conditions and swing trading. And swing trading is an art following the technicals, and we use a system just based on my trading guidelines. And then it's not something that you have to do, but it's something that can get you started. We tell you what the technicals mean. We do, at least in my system, I use 4 simple moving averages and 3 oscillators, and then the Bollinger Bands. And we teach how, based on these lagging indicators, how markets have the probability of moving during momentum, either up or down, based on support and resistance. And even if you're don't want to trade, you can still use these philosophies, and if you want to enter a trade on an investment trade, so that you're not getting in at the high, you might get in at a better price. So we've been doing it now for almost a year. In fact, January 1st will be a year. And we have a lot of good subscribers, and they're very active in the Discord. I try to answer as many questions as I can, in between trips and other things that I do. And I know you guys are all busy too. But we put on 2 stock lists. One's called the under the 200 stock list, which means it's trading under the 200-day simple moving average. And then we have a horizons list that means that the stocks don't quite meet all my characteristics, but they're close. And I also put out just a paper trade portfolio where I'll do 2 to 3 paper trade swing trades. Try to do it a week. Sometimes we don't get it because I don't have to be in the market every day. Like I was telling you, in November, we only did 13 trades, but I can't remember. We'll look at the chart. I think
It was only actually 9.
9 trades. Okay.
Yeah, 9 trades and 7 wins.
Yeah.
2
So
losses.
it was, yeah. But the wins were big and the losses were small, and that's what we want to do, and that's what we do as a team here. So I'm glad Trent opened it up. I hope more people get in. But the way we run it is I go through like the week that I see it, and we call those market conditions, things that influence the market this week. Oh, there's Paul. There's Paul. Paul's like a star trader now. So anyway, we'll bring him. We're going to add a section for him at some point. But
his list.
yeah. So Paul's now sending me nice stock recommendations, which I'll put on the list if he does, because he's following right up with what I try to do, and he's finding stuff that I miss, and that's what this whole team's about, and it's been good. So normally I'll go through market conditions, what formed the market this week. Then we'll go through the horizon list and the under the 200. And we'll look at the paper trade portfolio. We'll look at the market charts in general. And then we just open it up, and whatever questions you guys have, or you want to look at a chart, that's what we'll do. Trent will add in on different aspects of the macro and other ideas of the technicals that he sees. He's been in the industry a long time. He has a lot of friends that he talks to. And I know today's options expiration, and Trent might want to talk to that just a little bit because it's a big one, I think. And then after I get done market conditions, Trent, you want to talk about options, and then we'll do some charts, and we'll move forward. But so today, Trent and I are both from the same state, just on the other ends of the state.
Different time zones.
So we'll try to make it a timely meeting. We usually get done in an hour and a half. So whatever you guys want to do, we take the time to do it. And then I'll get back to my beer drinking and mimosas and margaritas in the windy state of Florida. So this week has been an excellent week for the markets and for swing trading in general, because the chairman of the Federal Reserve came out and presented the market with a real gift. And what he did, and he basically kept the Fed fund rate steady at 5.25 to 5.5% for a third consecutive meeting. And that's in line with the expectations. But what he did differently is he indicated that in 2024, there's a possibility of 75 basis points in cuts, which is the market is looking at 3 cuts at 25 basis points each. And that's what the policymakers are saying, that the recent indicators suggest that economic growth has slowed and job gains had moderated but remained strong, and the unemployment rate has remained low. Inflation has eased over the past year. Now, when it means ease, that means it's come down off of its highs, but it's still rising. And I saw a guy that wears the cow coat, I think he's a commodities trader or something. He came out and he says, well, I want to explain to my friends what inflation and, the lowering of inflation. He says, I'm kind of a fat guy. And he says, so if I'm gaining weight, and let's say I'm gaining 9 pounds a month or 7 pounds a month last year, and this year I'm only gaining 2, 3, or 4 pounds a month, that doesn't mean that I'm losing weight. It just means I'm not putting on as much weight as I did. He says, and that's kind of the way the rate of inflation is. We're not really going down. We're just slowing the amount that we're going up. And I thought that was a good explanation. And I just want to bring that up because it helped me. And it was funny that he said that anyway. So inflation has eased over the past year, but remains elevated. Central bank also published new projections. So these always get me because they project, years out. And I don't even know that they can project what's going to happen tomorrow. But anyway, GDP growth is expected higher this year, 2.6 versus 2.1%, but slightly lower in 2024, 1.4 versus 1.5. Also, PC inflation was revised lower for both 2023, 2.8 versus 3.3, and 2024, 2.4 versus 2.5. So we're talking a tenth, as well as core PC inflation, which is seen at 3.2% in 2023 versus 3.7, and 2.4% versus 2.6 next year. Okay. Unemployment projections remain steady at 3.8 for the remainder of this year, and 4.1 for next year. So they're looking for unemployment to go up. I think it's going to go up because we're seeing that. We're seeing layoffs. But I think it's going to go up a little higher than that. But that's just my projection. So-called dot plot, where all the Fed chair or the Fed board members put a dot on where they think inflation is going to be in the coming years, showed that the medium year-end 2024 projection, that's next year, for the federal funds rate fell to 4.6% from 5.1%. So they're looking at inflation just go down to 4.6%, basically. So everyone thought that
I'll be out of here by 1:30 or 2.
Bank of England and European Union would follow suit and lower the rates, but instead they stayed the same. The Bank of England came out and they stayed at 5.25%. The the ECB came out and remained at 4.5% because of stubborn inflation, they said. And the Bank of Mexico kept theirs at 6.95%. So I thought that might trigger, lowering around the world, but it didn't. Okay. So again, this next thing that came out, earlier was the CPI, which is our annual inflation rate, and it slowed to 3.1%. Again, we just talked about what slowing means in November, and that was the lowest reading in 5 months from 3.2% in October, and it was in line with market forecast. Okay. So what caused the CPI to go down? It was really energy costs. Energy dropped 5.4%. Okay. Last month it was 4.5%, and gasoline went down 8.9%. So that's where we find that the CPI came down. If you've gone to the pump, I know that I have. We're under $3 a gallon in the Midwest now. I don't know what you guys are at. Your different areas and different taxes, but it has come down. But it's still higher than it was, a year ago. On the other hand, we had prices rise faster for medical care, 5% versus 4.7. Transportation services, 10.1 versus 9.2. And compared to the previous month, consumer prices edged up 0.1% higher compared to the expectations of a flat reading and after being unchanged in October. So we are seeing, with core it popping up just a little bit. And a lot of that is because of higher housing. They thought that the housing and the rent was going to go down, but it didn't. So anyway, when the CPI came out, the market took that as good news. Okay. And that's the market's prerogative to take it as good news. Again, I think that people who live paycheck to paycheck and the 65+% of Americans who do live paycheck to paycheck, are probably not seeing the CPI news or the PPI news as really helping them out much. They're still paying higher prices. They might just be paying a little bit less on those high prices, depending on what commodity it is. So then after the CPI came out, Janet Yellen always provides me with a bit of comedy relief. So, she came out and said she doesn't believe the last mile in bringing inflation back to the Federal Reserve's 2% target will be particularly challenging. Inflation is certainly meaningfully coming down, she said. So I know she lives in a different world than I live in, but gasoline prices have come down. But when you look at car insurance, when you look at property taxes going up, and you look at certain aspects of food prices, I don't think she probably drives herself or probably fills up her own car or probably grocery shops or even matters. But it's always fun when she comes out and says that. So the producer prices came out later, and that's the prices steadied from November from October, following a downward revised 4% fall in the previous period, and compared to a forecast of a 0.1% rise, prices for both goods and services were unchanged. So basically, the PPI came out and it was better than expected. And again, gasoline fell 4.1%, which helped out the PPI. Energy is really important, even though it's a smaller portion of these indexes. It's very important to the index itself. Everybody uses energy, whether you're a producer of manufactured goods or you're making plastics or whatever. You use energy, driving your car, heating your house. Let's see. Core producer prices in the United States, which exclude food and energy costs, remain unchanged over a month in November of 2023, as it did in October, compared with market estimates of a 2% rise, 0.2% rise. On a yearly basis, U.S. core PPI rose by 2% in November after downward revised 2.3% increases in the prior month and below market forecast of a 2.2% advance. So again, we have revisions down. We have PPIs that rose more than expected. Same thing. What do you believe that comes out of the government? We're always revising things up, revising things down. So really, I look at things around me, what they cost, and that's kind of how I gauge inflation for myself. But the market took it as good. And then when the Powell came out, and now you see what's happening in the market, and that's good. For a swing trader, it doesn't matter what the news is, as long as we have momentum and the momentum goes up, that's good for us. Now, and the other things that kind of what I looked at this week is the U.S. government budget deficit came out this week, and it widened to $314 billion in November of this year from a $249 billion gap in the same month of the previous year, and came above market expectations of a $301.5 billion deficit. The November figure was a record for the month and the highest since March, driven by significantly higher interest costs and other expenditures. So our deficit is going up because our treasury yields are still high, even though they're coming down. If you go and you still have to get a treasury bill from the government, you're still getting over 5% on a monthly basis annualized. So we're still paying higher interest rates for the debt that we continue to spend in this country. So that is going to continue to widen our deficit. So revenues on the other side witnessed an increase of 23 billion or 9% from an earlier year, reaching 275 billion. Meanwhile, outlays experienced a substantial jump of 88 billion for 18% a year earlier. So our outlays, which is our expenditures, are going up, and our revenues have started to come up after being down, which revenues is really taxes and what's coming in, basically to run the government. The other thing that was interesting that wasn't on the main news was about China. And in China this week, what's that? Okay. In China this week, consumer prices fell the fastest in 3 years in November, while factory gate deflation deepened, indicating rising deflationary pressures as a weak domestic demand casts doubt over the economic recovery. So the consumer price index dropped 0.5% both from year earlier compared with October data, and this is from their National Bureau of Statistics. That was a deeper than median forecast and a Reuters poll of 0.1% decline, both year on year and month on month. Durable goods prices are stagnant. Cars and motorcycles dropped 5% in November. Smartphones and other telecommunications equipment fell 3.7%. Prices of furniture and appliance purchases, which tend to go along with home buying, sank 0.7%, among a real estate slump. In the service sector, airfare turned negative as travel growth slowed. So what we're seeing in China is a slowing of growth, which is deflation. Okay. Now the government doesn't want to call it deflation. Okay. The People's Bank of China said in the quarterly monetary policy report that household inflation outlook is stable over the medium to long term, and there are no factors that would produce long-term inflation, deflation, or inflation. The central bank conducts quarterly surveys that examines household inflation expectations in either factors. The July-September survey results are normally released in October, but the latest data has still not been published. Some market watchers speculate that the People's Bank of China may be reluctant to report the results because of inconvenient findings such as further loss of consumer confidence. So deflation can be both good and bad. Deflation is really a general and sustained decrease in the price level of goods and services in an economy. So the benefit is that it increases your purchasing power as a consumer because you can buy more for less. The prices have come down, but it's detrimental because it makes it harder for companies to pay down their debts because their margins are lower. And also, it also has an effect on the consumer. That consumers think, well, if prices are continually going down, I'm not going to buy right now because it's going to get lower. I'm not going to buy that car. I'm not going to buy that washer or dryer because the prices keep coming down. So that slows the economy too. But China doesn't want to admit that. But Chinese economy is actually slowing, and so we'll see how that affects the second largest economy in the world, and we'll see if we follow that path too here in the United States. Last thing I have, making this one short this week, housing. Let's talk about housing, and the rate on the 30-year fixed loan went to 6.95%, and that's the lowest since August. And that's a drop for the seventh consecutive week. A year ago, it was 6.31%. So we're still higher than we were, but it is coming down. And that's coming down because you're seeing the treasury yields come down too. And then when you look at employment still, according to the way that the government reports employment, filing for unemployment was down by $19,000 to $202,000 for the week. The expectation was 220,000 claims. So that was the lowest level of claims in 2 months. And the continuing claims did rise by 11,000 to 1.876 million, but the expectation was 1.97 million. So we're seeing strong employment, but if you get into the nitty-gritty of the employment reports, you can see they kind of fudge things around. Some people they count that have 3 jobs as 3 separate jobs, and things like that. So you just got to be careful of the employment report. But if the economy does tend to get out of hand, you're going to see it from probably a higher rate of unemployment than we're seeing now. I think the last level was 3.9%. And we'll just have to watch that because that starts getting up above 4 into the 5%. That's really going to have an effect on people's ability to spend, buy houses, and do things as such. That's my abbreviated South Beach market update for this week. And Trent, I wanted you to say a couple of things, what you know about the expiring options market today and how that might affect the market, if any.
Yeah, so this month the options market has created a low volatility. So if you look at the VIX, the volatility index, which measures the volatility of the S&P 500, has pretty much stayed below 13, which is pretty abnormal, especially in the last couple of years. And so basically the options market has created this neutralization of the S&P in particular, but the major indexes and stocks overall. It's sort of like a hedged market never boils over. Today is the largest option expiration known to mankind, and that will represents $3.25 trillion that these options represent. Now, what could this cause? This could possibly be a lot of that could be rolled into next month. So it creates sort of a semi non-event, or it could be a massive expiration, which would then basically pull the floor out from under, in particular, the S&P 500 and some of these other indexes in individual stocks. So it's a matter of what will transact at the end of the day, market close today. Will you see, another, say, 2 trillion or 2 trillion of those options roll into January, or will you just see it zero out, or a majority of it zero out, which would then cause a negative effect on options and could create an enormous jump in volatility. So if you think about it, the VIX below 18 is more of a bullish environment. A VIX between 18 and 30, as once described by somebody I follow, it is the chop bucket. This is where people get really chopped up in their trades, or and could get and lose money. And then 30 and above on the VIX, this is when things blow up. And so we are on the very south side extreme of those ranges, down below 13. And a lot of this has been due to the ability of options subduing volatility in markets. So the question is will we see the continuation hedging of indexes and markets, or will we see that roll off because basically it's year end, they'll zero out their books, and will we see a jump in volatility, which could create a, it could create a unfortunate position for, buy and hold investors, or it could create, enormous volatility. So really there is no clear answer of what's going to happen, and we probably won't know until we go into next week. I think one other thing that I found interesting that I came across was that year over year, there has been a 34% increase in gold purchasing by central banks throughout the world. And there's been a lot of question of why that has been. And the head of the Dutch central bank was asked this question, and right now gold in the Dutch world represents 4% of their GDP. And they basically said that they find gold useful as a financial backstop. So it sort of gives this, with the option world being the way it is recently, the explosion in growth in purchasing in gold, and then the decline in energy prices, it really looks to me like this is all setting up for a recessionary environment, and could be a similarities to the 1970s stagflation environment, which I think creates an enormous opportunity when it comes to being able to learn to swing trade these markets, because it is a more of a short-term strategy that allows you to capture gains without risking an enormous amount of your assets to do so. And I think in a stagflated environment, people are gonna need growth, and this is a great way to do it. So, but yeah, I'm curious about the options market and what is about to transpire. $3.25 trillion in expiration is an enormous amount of money that it represents. And when those hedges come off, then there is no floor beneath to support it. And that's what it's been doing for, as you have pointed out, Mark, for the last week it was 9 days. Now it'd be 14 days, 15 days.
We'll take a look at the chart next.
Yeah, sideways movement. So I'll let you lead into that,
Okay.
and I'll give you access here.
Yeah, let me see this. I don't have my full, obviously, armament of hardware here in South Florida, so we'll try this out and see how it works.
Trent,
Okay.
should we be concerned if the options are puts or shorts, or leaning, whether people are gonna, I mean, you might argue that the options will work for the market.
Well, I think a lot of it's the mechanics behind it, where, you go buy a call option, the market maker then goes and he hedges that. And so he may be buying a futures contract on the SPY to hedge out your SPY call, and then he'll sell a put to pay for it. And so he's neutralizing. And the problem is this is going on, is representing a bigger basket of assets. It's then when they unwind these trades, and you were probably seeing that throughout today. And because once those trades, those options that you purchased expired, they have no need to hedge anymore. So they unwind their trades, which creates, this opposite of what it did create. It now creates the different, opposite version of that. And so that's the question is, will they just roll these options into January with being fearful of something, and we see a non-event? I think we saw that in October and November, and that's why we got sort of what we have had for the last 60 days or so. So it really, we'll see. And that's where I'm like, it's just an interesting environment when it comes to these.
It's
So in
interesting
October,
now. Go ahead.
I was just going to say in October and November, there was a blip on those, on the option expiration dates.
Yeah.
You could see it in the market.
Yeah. But
that would be neat to look at. Like if you knew those October what and November what on those expiration dates, if we seen the behavior of the market, that'll be good. Like,
yeah, well, the other side of it is this is bigger than that. Then that to me is, that's telling, because people are hedging out even bigger with the fear that, the Fed could have raised rates or something, or some bad news. The question is, once you've wound that top up, you've got to unwind it. What happens? I don't know. Go ahead, Mark.
It's interesting because the market, at least here in the S&P, turned kind of flat now. And I'm just wondering if that might have something to do with it. But you can see we did, as Trent was saying, we've been going sideways until this week, this Friday, Thursday, Wednesday, Tuesday, Monday. And then the CPI came in, and then the Powell talked, PPI, and then today we're down a little bit. We're following right up on the Bollinger Band on the SPY. And we got cells up here at the top. I got to move my people here so I can see. There we go. At 477.37. We're seeing a little bit of a downtick on the stochastic, but again, this market's been going up for quite a while, and that's a lot of momentum. And then you come down here, and these are gaps in the SPY or the S&P 500. There's three pretty good sizable ones there's two above the 200. And like I said, markets have momentum. We went sideways here. We jumped on the euphoria. Just be careful when you get in as swing traders or as an investor. It's great that the markets go up, but it's very rare that they go up for a long time without releasing some pressure on momentum, because at some point the institutions are going to say, wow, we've made enough money. It's time to pull the rug a little bit, take some profits. And that can happen anytime. Or this market could continue to roll up depending on how much money is flowing in to the market. But we watch the charts and we can see, we're following the upper Bollinger. Whenever it gets above the Bollinger, it only trades outside of that band 5% of the whole time. So, it's probably going to come back in at some point. So anyway, that's the SPY. Let's go look at the Dow. And this consists of
so it might not hurt to have your your limit loss, or your protection with the blue line there, or maybe a little bit up. I mean, adjust your sell to protect your gains.
Well, and you should, as markets go up, especially, I think I said when the FOMC came out, I think I put out a note. I know I did. Adjust your stops up, because otherwise you're going to get stopped out at a lower price. Follow the price up with your stops, but be mindful, of where support and resistance are. And Margaret, I know we talked a little bit on the Discord about 3M. You got into 3M, and 3M was trading sideways like this.
Right.
And I normally don't like to trade anything sideways unless you're going to trade range bounds, which is, you're seeing it going up, down, if you want to try that. But until you get a breakout, and this is a breakout on the Qs and on the Dow, that's when you want to try to get in. But you know, the main way is to get in is right down in here and ride this all the way up. That's what we're looking for. That's why I go look at all those dumpster stocks every week and try to bring those to mind so that we get this gain here as opposed to getting up here. You know, now we're like, okay, what do we do here? Are we towing sideways again? We don't know. Okay, so it's a different world, and there's a lot of emotion in the market now, and it's been my experience. And Trent, you can give me your 2 cents that when the emotion flows like this, at some point, uh, we're gonna have some correction to the downside, and I don't know when that's going to happen, but
You
it's
know,
just hard for a market to go like this for a long time.
for the last 15 days, I've received your early morning market commentary, and you post in there the greed index by CNN. And I have watched it go from neutral to today, on the very right side of the greed standpoint.
Yep.
And to me, that is a very big indicator of people have gotten comfortable. The wording of the Fed saying we're likely to cut rates 3 times, even though one of the New York Fed chairmen came out and said, well, we really aren't talking about cutting rates today. I thought that was interesting. To me, that when you see this extremeness in emotion, that is an indication to me that something will give. If it's extreme optimism or pessimism, you know that, as I spoke about last week, the other guy on the other side of the table is thinking this. I'm gonna bank on their emotions, and I think we're getting very, very close to that point. And with so much in option expiration today, we could be up against that that point at this time. So only time will tell, but I think it's very important just to be aware that to manage your risk, you know.
And again, you know,
Don't
you
lose
guys
money.
you have enough knowledge to look at these charts
Yeah.
and see what's happening. This kind of looks like what we just looked like on the Dow for the last 3 days. You know, this one exactly, this is the Qs, NASDAQ 100, sitting right on a resistance line, the intermediate resistance line. And can it go up? It certainly can. But look, it's been above the Bollinger now for 4 days, and that's hard to do and keep going above the Bollinger. So as a trader, you train yourself and say, okay, what's the probability of this continuing to go up, or is it going to release a little pressure? And then you go down, you start looking at, you know, different stochastics, even though they're high. Um, and that's when you make a decision. Okay, if you're in back here, you might take some off, or you might write it because you have a nice cost basis, which is good. But if we go and look at what's happening, and it's pretty true in the markets, the breadth is widening out. Because here's Apple. Okay, Apple looks like the Nasdaq. Okay, it's up against resistance. It's kind of going sideways. But let's go out to the equal weight. The equal weight S&P, and you know it's still sideways. But here's where Powell came out, and you know people went out and they bought the equals, you know, outside of the Mag 7. But again, we're still right around this intermediate resistance level, and that's a hard level to get by. And
Yeah.
we've seen it time and time again. And again, we're following up the Bollinger Band, came back down, and we're tapping off the 9. But again, you guys have enough knowledge now to watch and see, you know, what this means. And you see markets go up, you see them go down, and utilize our moving averages and our Bollinger Bands and our resistance levels to make educated entry and exit points. And again, we're not trying to make the tops, we're not trying to make the bottoms, we're trying to make a profit.
Yeah.
So anyway, Bob, you have a question there?
Yeah, I just got one question.
Sure.
I know what you're talking about, your swing trading, your short-term holdings. But Mark, in the case of your long-term holdings, are you using stop losses on them?
Yeah, because I look at longer term charts instead of daily charts. You might look at weekly or monthly charts, or you can use, this is the old one, you know, the old standard is the 200-day moving average. So here you go. If you're in this, you had your stock one full candle above the 200. and you write it back up. And you know, for what you're trying to do, Bob, is let me widen this out on your investments.
That true,
I mean,
200 days fallen.
Yeah, look at this.
Yeah.
Let's say you got in, I'm just going to draw a line. And, oops, I'm going to draw a line. We've done this there. Let's say you got in, I'm just going to pick here. Okay,
Mark, can I ask a quick question?
sure.
Do you set your stop, what is this thing? It's one of the technical analysis, the stop. Do you set yours at tight, medium, or loose?
I'm at intermediate or a tight. I mean tight on the swing trade.
Okay,
Tight,
all right,
tight and above.
okay,
Let's
great.
just say, let's say you're in this ETF and you get in somewhere in here, Bob. It's going sideways. You get in and you're an investor. You know, about this point here, which is the end of the year in 2022. So you are now losing money. You're in here. Here's price action. This is called opportunity cost with your money. You're not making any money or actually losing money. You might be getting some distributions. Yep, let me see, I gotta move my, so you're still out of money. This is opportunity cost lost, okay?
Yes.
If you would use, well, see here, not even over the 200 yet. If you would have waited and got in here, okay, I don't see, I can't get the 200, go back that far. It's been so far
Apple
under
might
it.
be better.
Yeah, which one? Apple? Yeah, let's do Apple.
Yeah, it might be better because the 200's going up. It's easier to
There you go.
logically, yeah.
Yeah. Yeah, there you go, Paul. Oh, here's my 200. So if you would have gotten in up here, let's just say this line right here. Well, let's go right down to the 200. Here's our 200. Let's say we got out here, the 200. We missed all this downside. We're watching the 200, watching the 200. You could take that money, put it in a treasury bill, and then you see it pop above the 200. You get back in, comes back down. You either stay in or get out. You probably, I don't know if that's a full candle. Get out, get back in, you ride it back up. You missed that missed opportunity cost. You're still riding it. You came down, you might have gotten out here, okay? But then you're right back in. So what you've done is you've missed all of this losses. And this is just on a 200. This is an easy way to do it on your investments. We have more technical ones that do a little more than this. But the 200 is something that Paul Tudor Jones used in 2008 to get out of the market before the big dump. So again, if you have an investment, long-term investment, Bob, and you're worried about losing it, you can kind of do this on a long term. If this comes back down and gets under the 200, you might want to consider, you know, it's not financial advice, but you may want to consider just based on, you know, the long-term trend to pull it out, put it in treasuries, and then when it comes back up, put it back in. Save yourself
I mean,
all this time here.
you could,
Yeah, Mark, I totally understand on the opportunity cost. It makes a lot of sense. I appreciate your insight on that.
Thanks.
I think if you
What
look
was-
at the SPY, the S&P 500 index, and you apply just the 200, if people would just apply the 200-day moving average,
Yeah.
you could save a lot of money, you know, over the last 20 some years.
Yeah.
Can I
it's an
just
easy-
say something?
Yeah. Go ahead.
Trent, going back to your dad, in one of his illustrations, it was done a while ago. We're talking about the Big Seven, and he went back to their, I guess, IPO and on up days.
Yeah.
And so he said, if you followed that, you go, I don't know, what we're talking about, 30 years
Yeah.
on a portfolio, you would have had, I think it was $9 million. If you had done the 200 moving day average that just we're talking about and utilized that, you would have increased that $9 million portfolio up to 54 million.
Yeah.
Right,
That's an
I saw that.
incredible amount
Yeah. And it's
by
really
doing
not,
that.
it's not a complicated strategy.
No, it's not. It's a really elementary.
I-
Yeah,
Elementary.
and- Go ahead.
I think, when Paul Tudor Jones, one of the most successful investors of all time, manages billions of dollars for people and now for himself, and he flat out says, I got out of the market because it broke the 200-day moving average. You got to sit back and go, well, maybe he's got something there, and for the average, having come from 20 years in the financial advising business and understanding how those guys get paid, or their broker dealers get paid, being out of the market doesn't pay that broker dealer. And that's why they're so adamant about just hold the 60-40 split. Just hold it out. It'll come back. Whereas if they were taught, if it breaks the 200, if the S&P breaks the 200, or whatever position breaks the 200-day moving average, you start to reduce your position. So many people in retirement would not have gone through .com, housing, the COVID and whatever else is to come. They just wouldn't. But it's all about getting paid.
You know,
So-
Trent, I
have
tell you something. It's so important. I look at myself. I mean, you can have all the degrees you want in finance and that. And these things that appear to be quite elementary, I wished I'd known this about 30, 40 years ago. It would have changed my life totally.
Yeah, it would change everyone's, because, it's even today, people that I know, they spend more time planning their vacations than they do their financial future, And I'll ask them, what are you in? I don't know. It's like, I got my guy. I says, well, doesn't he tell you what you're in? Well, I get a statement. Well, how often do you talk to him? Well, once a year when I pay him, or, whatever. And they don't understand. And then this year we've had several times where I've talked to people, and they're just mad at their financial advisor because they're looking at, an S&P, or, up 15, 20%, or the NASDAQ up, whatever. And they're looking at their statements, and they're looking at 3% maybe, or 4%, and they're just furious. Well, how often does your financial advisor go in and look and actually adjust your account based on anything? They don't, because they get you into a balanced portfolio. They say, all a balanced portfolio does, and even Warren Buffett says it, is give you a balanced, lower return rate, because you got all the losers with the winners in there, pulling them down. You got bonds, and you've got money, and you've got international stocks, and you've got little stocks, and you got medium stocks, and you got growth stocks, and you got value stocks, all in there. And value can be the way to go, or growth can be the way to go, but everything else pulls you down. So what you end up with is a portfolio of mediocrity.
Yeah. And by the way, it's interesting you say this, Mark, because Kerry just brought that up on YouTube today. He had Warren. I know it. Well, he didn't have Warren live, but Warren is very much an opponent of diversification. You're not doing research on if you do research on the companies that you're want to be involved in, you should know what's going on. You don't really need that diversification. And man, this has been so much pushed down investors' throats. And a lot of people have had it pushed down their throats and don't even recognize it.
Yeah.
It's all about who's getting paid.
Oh yes, no doubt about it.
Yeah.
No doubt.
That's 100% why when I saw that one that you were talking about, Bob, that Kerry did about it, if you had sold it and rebought it, it made so much sense. And I just said, I'm done. I'm taking this over myself.
Yeah.
I think and Mark, I don't mean to take it up here, but you're right on ball. I have money managers, and I'll tell you, this year, the past couple of years, I've really wondered. I take a look at what they're being paid. And even though I know these people well, if they quit talking to me after I pulled everything, I could really care less.
Oh, and they won't.
Again,
They
it
won't
comes
call
down to
you.
your own self-survival. We're talking Darwinism.
Yeah.
Could we run a deep dive on long term? Because I think I got a good handle on swing trading, but I got a lot to learn. But I'm migrating that information, that knowledge, to my core positions. I never say I would admit to this, but I sold NVIDIA, and I had not all of it, just a portion of it. And the reason is I said, I think there's more opportunity in other sectors.
Yeah.
But I have a trouble following, for instance, that 200-day average rule. I think that it would be worth, and maybe not with the group, but if we do because really a core investment is a big swing. right? You may not, well, NVIDIA wasn't hot 5 years ago, but there's going to be a time I should be out of it.
Yeah.
And I need to get comfortable with, or nimble to get in and out of my core positions. And the 200 days is a good way of doing it, but I wouldn't mind following up with some examples of deep dive. And I mean, you looked at the 1 year chart, or you could look at the 2 year chart, you could follow the 200-day, but actually have in and outs, and maybe spend a little more time on, as we do with swing trading, which could be 1 day to 5 day, 10 day, but with a
Or
core
2 minutes,
position.
or 2 minutes with you, Paul.
I did 10
Yeah.
minutes today.
But you know what
I
I'm getting at, where we
Yeah.
talk a lot, but we just get in the
I,
surface on core.
I do. I use a system that I developed on. Kerry has his bus 13, and every Sunday or Saturday, I update his entries with my entries, whether I'd be in or out of his core positions. And that's what I utilize on that, to based on a little more detail and a little more, more than the 200, a little more analysis. And so we've been doing that. I'm seeing how that works out, but it looks like it's working fairly good. And so watch that a little bit on the side, that I have that going. But yeah, Trent and I have talked about that, and I think we want to do that. And we've got to work on that in the new year to get that going.
Yeah.
But yeah, so we'll work on that.
Yeah.
That would be awesome, because I could manage the swing trades even better than I could manage my bigger portfolios. Like, I'm doing well on some of these big core positions, but then I'm looking at Tesla. I'm like, why didn't I get out of Tesla? I mean, I like this company, but it's just not trading where I'd like to be.
I
It's
think
under the 200
I
day,
think
whatever.
one of the things I've learned is that we get attached to names and ideas.
Yep.
I think the best idea to get attached to is I promised myself not to lose X percent
Yep.
in anything.
You
So
really,
if I own NVIDIA and I say this is my long-term core holding, I promise myself I won't lose 7 to 10% of this position. And if I get close, I match that up with a simple 200-day moving average or a 90-week moving average or something like that. And if that rules are broken, then I sell it. And I think that's more of what we as core position holders need to adapt is, if I lose 10%, more than 7 to 10%, I got to make all that up. And in a downward trending economic environment, it's going to be a long time. Unfortunately, we age. And, I remember after the housing crash, the average 401k holder that we used to manage 401k plans took 4 years to get back to where they were prior to the crash. But when you're 55 years old, in 4 years later, you're finally at break even. You don't get that time back. And so I think that's the misunderstanding and the robbery of what people has been taught.
well, it's the robbery of the middle class and the retail investor. It's a robbery of their wealth. It really is. And it's putting trust in an industry that has continually, and I've worked in this industry, screwed the retail investor each and every time. Okay. And it's not illegal in any way. Might be a little immoral, but it's making money. And they're throwing a little bit of crumbs out there. I mean, you're making some years 7-8%, I'm sure, on returns, and other years you're losing 10%, and in the end you're making 3 or 4% over your lifetime of dollar cost averaging in your 401k. At the end, you're going to have a nice little amount there that you wouldn't have had if somebody didn't make you put that in there. It's just what they put it in there and how they manage it that could have made you more.
Yeah. I often think about, I remember meeting I don't know if he's still the fund manager for the Fidelity Contra Fund. This guy, he got into Google when Google IPO'd, and it was a big chunk the last time I looked at it. And I always thought, if you just followed the 200-day or some version of that in a weekly period of time and just held that fund, and then when it broke that simple moving average and then sold it and then got back in when it broke back up north, you'd have made a crap ton of money.
And then
It just,
over the course of a year, you would probably only trade it 2 or 3 times, maybe,
oh, in a
maybe.
bull market, think about it, from 13 to 19, you would have never sold it.
No, no.
Never.
But you would have been out between '08 and '09 for sure.
Absolutely.
Yeah.
And I think that's, when it comes to core holdings and going to Bob, as you mentioned, Kerry's video about diversification, you don't have, not advice or a recommendation, you don't have to be diversified a 60-40 split. You just have to have the process. And I think that's what swing trading has taught me and a lot of people is I can apply these short-term concepts to a long-term perspective. And I can start to see how to manage my core. I wish more people would, because I think a lot of people are getting hurt in the next.
Well, the thing is that people, number one, we don't educate people in financial situations and how to grow their money. We don't educate kids in school. We don't educate them in college on how to do this. And then the other thing is you got to want to know how to do it like you guys do, to come here and talk about it and give your successes and say, oh man, I missed that trade. What happened? So that we can say, well, this is what happened. And, next time you remember it. If you don't put the time in, you're not going to get the benefit out of it. So again, we're not here to tell you what to buy or what to sell or at what price. We're here with a process and a way to give you a better opportunity and provide you with some companies that have, a higher than average, probably a probability of going up based on lagging indicators. Nothing's ever 100%, but our track record shows in our list, in our paper trade portfolio, that you can, if you apply basic principles, you can have a higher winning percentage by getting out of trades before they get too far away and staying in the trades that run, that you're going to have a higher probability of success than a guy who doesn't do this.
Yeah.
Hey, can I just say one thing? We've talked about
Can I ask a question
minimization
too
of
whenever you get a
losses.
minute?
Yeah,
Okay.
Jason.
Jason's hand's getting tired.
Go ahead,
How
Bob.
about maximization of profit? And instead of looking at a 200-day moving average, should you be looking at a 9 or a 20 to decide? Let's say it's getting up there close to resistance line. All right. And you got a lot of profit in there. There's a point where you got to pull it. I mean, to wait for it to go down to the 3 or the 200-day, that's a long ways of waiting.
Well, that's a different. See, when talking about the 9s and the 20s, we're doing swing trades. We're doing short-term in and outs. Okay. When you're talking about the 200, we're talking about long-term, more investment. Okay. So I wouldn't swing trade off the 200, but I would certainly, in a swing trade situation, use the 200 as a resistance or a support level when it got there. And in a long term, if you're just Paul Tudor Jones, just say if it gets above the 200 on a daily basis, one candle close above, and you look at, I look at other oscillators that tell me which way the momentum's going and how much momentum there is, then you might want to get out or get in, depending on which way the direction is, and if it goes sideways along that 200, you're going to be going in and out for a while, but eventually it's going to break one way or the other. And, you just want to lose that downside on the long term. But that's a long-term indicator, Bob. That's the 200, okay? That's 200 days of past price closes that get averaged in and divided by 200, as opposed to 9 days, which is really close. And that's where you get, a swing trade. So it's the difference between a long-term perspective and a short-term perspective. So back before all this stuff happened and we got
Hold on.
a couple years ago,
Jason.
I got out of my index funds because it went below the 200. And then I put them into treasuries, and I still have majority of stuff in treasuries. And now I'm just swing trading until we figure out what's going to happen here.
Yeah.
That's
All
my
right, Jason,
personal life.
jump in
Jason,
here,
go
please.
ahead.
Can I ask a clarifying question on the 200? I'm new to a lot of this. So when you're talking 200, you're talking long distance. Are you talking just for something like the S&P or the QQQ? Or is this something that you would do like an individual stock also to say, hey, I want this long-term, say, Tesla or whatever. I want this long-term, so I'm going to pay attention to that 200, but not necessarily on a daily basis, but more of a long-term basis? Or would you look at it still daily? okay, it's hit the 200. I need to start thinking about my adjustment.
Well, if you're only using the 200 as your in your long term, then you would stay in it as long as you're above the 200. Here's Apple.
Do Tesla,
Okay.
that bumps around a lot more.
Let's do Tesla.
As I'm watching Tesla right now.
Let's watch Tesla. Okay, let me back this up. So here's Tesla. Now, if you're long term on Tesla, okay, let's go back, see where we would have got in.
Can you go back 5 years?
Yeah. Here's 5 years of Tesla. Okay. So if you would have gotten in, let's say back here, you got above the 200. Okay. And it's very small. But you rode Tesla from, I'm just going to pick it out, 23, 26 right here. Okay. You're above the 200. You're still above the 200. You're still above the 200. And I'm saying that Tesla is my investment. You come all the way up here, you're still above the 200. Come back down, right in here somewhere, you might have gotten out. Okay. So now you're at 200 or 190.95. So from 23 bucks to 190, you are out, but you made that profit. And then it kind of goes sideways here, very small, sorry. And then it pops above the 200 again. Now, let's just say it's right here, 218. You ride this, still above, and then it comes down and it might have dropped here. Okay. You're at 268. Okay. So you made from 218 to 268, about 50 bucks a share. Came back up, you go up, you go above again right here. I'm just looking 290. Rides all the way up, comes back down, 292. You made $2 on that. You got out, you missed all this opportunity here. Probably didn't do much here. You missed all of this and got back in right over here. And I'm just going to say it's 193.17. And right now we're at
That's 1 year later.
252.51. Okay, so you're missing everything that's under here is called a lost opportunity cost. Everything over here, you're called your profits. That's just using the 200.
And so would that be a daily chart that you're looking at though?
This is a daily chart. Yep.
Okay.
You could do, I mean, if you wanted to do a weekly, you could do a weekly, I'm sure. If I can find my that stuff in the way here. Oh, I got to get out of this chart, get back out. Got all everyone's pictures in the way here. Share screen. Hold on. And go back. Draw.
I have Tesla and I'm looking at the 1 year daily chart. And
1 year
you can see
daily.
it's, yeah, and right now we're still above the 200,
Yeah.
but we fell below the no.
Okay, here we go.
Yeah.
So here's your 1 year. So here's where you probably would have gotten in if you're just doing long term. If you're just using the 200. Okay, simple. You're in at 1 or 203.93. You might have gotten out right in this area, 216. So you're up, 14 bucks. You come back down and here's your sideways. Then you pop back in, 237, and you're still in today at 252. So you're up, whatever, 52 minus 37. And that's just that's an investor style. But the way you get in trouble is when it goes sideways a little around the 200, because the 200 acts as support or resistance. And sometimes, like here, you got several days, you're just kind of going back and forth. That's when you might want to just sit out and just wait and see which way it pops up or down. And here we went again. We went sideways here again. But for a majority of the time, you're seeing either ups or downs. Again, here's sideways too, but you're over the 200. So if you'd have got in here, you'd be sideways, you'd still be doing okay.
Thanks. Appreciate that. Yeah, very much. Thank you.
I want to show one more thing here. We usually go in and we look at what we've done. And this is our horizon list. Okay. We had a pretty good one. This one here, TEL. Of course, everything did good. You know, you can look like a star when you have a week like this. And I should send some roses to to Jerome Powell, because he made me look like a rock star this week in my picks because everything went up. So, you know, I'll take it though. But you know, in the picks that we had here, we ended up, you know, $1,700 on the bunch. We were down on one. This was during earlier part of the week. It went down below support, so we got out of CF. But again, you lose $46, but here you make 1,000. Here you make 480. Here you made 55. But this TEL, these are the ones, like we say, that you got to let them run, and they run up and they can make you some money. Let me go show you that one. Okay, hold on. And we'll go back to 3 months. TEL.
Maybe we should hold on to Foot Locker.
Yeah, that would have been another one. But here you see we got in right here. Okay, we got above the 9. We're above all the moving averages. We got a nice stochastic and everything going down here. Popped all the way up, came up here. There's the green line. This is where it hit. And that green line, that intermediate resistance on this chart, has made me more money than lost me money for sure. And if it goes higher, like this week, it popped over a bunch of them because, you know, market's in euphoria, that's fine. But it came up, hit that, got out, and look where it is today. You know, so this was just classic, and it brought in a lot. You know, we let it run. We could have got out at the Bollinger, but as long as you're above your cost basis and you have a little bit of risk, you can ride this up. And of course, here's what happened. And now it's down. And where's it down to? It's right down to where the cells are, right here. So that turned out to be a pretty good one. If you look at our under the 200-day list, let me go back to that one. I just like to show these because, you know, they are good lists. They don't mean that you should go out and buy everything that's on it. You need to set your own risk in, what your risk tolerance is, and you need to decide, okay, how much do I want to risk, and how much risk is on the upside and how much is on the downside. Now, TLT's been on it for a couple of weeks, and this we've been riding because of the interest rates. And when the yields go down, the price of TLT goes up. And right now we're up about $7.51 a share. These ones in the yellows hit resistance or support and got out. You can see we've done pretty well here. On this list, we had 15 shares. Stocks, we up 3,200 if you had invested $100 shares in each of these at the price when it was listed on the chart. Now, again, this is not a buy price. This is when it just gets listed on this chart. I would wait in most cases to try to get a better entry point using the volatility of the market. And I know, Paul, you've done that pretty well. I think market's done that pretty well too, to get in at a better price than this. And that's why some of these get losses, because I didn't get in. I'm not getting in at the right price. I'm just putting it on this chart at the time that the indicators look good. But we got others like Verona Pharma up 224. We got out, you know, these got out all at gains. We had 2 losses out of 15 so far. I haven't totaled it all up. But, you know, it's been a pretty good week, and I have to thank my buddy, Mr. Powell, for helping me. And I'm going to do a couple of these. Let's go look at TLT.
Well, one thing, Mark, I had 4 different ones that I tried to get in at a better price. It was one of the days I was going to the barn, so I set the buy limit, and I couldn't get in. I set it too low. So
that's fine.
It's kind of a
that happens, but that's going to happen, Margaret. You know, it's like my mom, again, I tell her she only bought things on sale. And if there was a sale going on and she got to the store and that stuff was gone, she just would go home. She didn't buy it, you know, she missed it. But you're going to get better at picking those based on, you know, the support and resistance levels, and you're going to catch enough of them. But what you need to do is just forget about it. If you miss it, go on to the next one.
Oh yeah, I just learned from it.
Keep your emotions out of it and just move on to the next. Same with cells. Okay. Now in TLT, I just think TLT right now with the situation, as long as yields are doing what they're doing, and we can go back, you can see what's happened. Let's go back 2 years and see what's happening on the TLT. And we have been under the 200 for so long on TLT. And now, all of a sudden, we're seeing a little bit of shift in the markets and the yields. Now we're over. Okay. We could have sold at any of these parts. Here's our cost basis. We could have sold at any time. Has it gone up? And then it did come down and hit the 9. So in this case with TLT, I'm using the 9 as support. It never went down below, never got to the intermediate support level, left it in, came back up to the Bollinger, and then boom, one candle above the 200. Now we're 2 candles. We're still following the Bollinger. This is pretty strong, and we got in a good position. This could be one of those big runners, okay? And it's already run. When it
It's
got
like-
over the 9 here and it was under the 200, it was on or under the 200 list, and it just stayed above the 9, didn't get under the below it, didn't get below it. And this would have been a good runner too. Here we're at 87.04 and we're at 98.83. It's not a big winner, but it's a steady. And these are the kinds you want to get into and just let them run and keep moving your stops up. And on this one, I'm watching the 9 and I'm not, I would put a stop. We're up enough. Let this thing float a little bit, and see how far it runs up. Good one. I mean, that 30-year treasury, we're swing trading, Tech. Here's another good one that was on our 200-day list.
But
So
you have
Tech,
that added knowledge. You have that added knowledge on the stock to help with the decision. So it's not just the charts, it's that you know what's going on with the interest rates. And you could have that same thought process with like Meta, for instance, or any stock that you're
Yeah.
close to, may have another deliverable to help you make a decision on whether to hold or not.
That's absolutely
gonna-
true, Paul. And
yeah.
like you have stocks that you've been watching for a long time, about, you've seen patterns and you get that in your head. I've seen this before. And that's why we go over at the early part of our call is the market conditions, so that we're not really trading on market conditions, but we know they're out there. The known market conditions can affect how our stocks trade. So we need to know that. But we use the charts and we use the technicals to really help us. Here's Tech. I mean, again, this was such a great week because when Powell did this, everything went to euphoria, and we got into Tech back here at 68.05, right here, yeah. And it's just been roll. Here was Powell. He helped us out, got above the 200, still above the 200. We're still above the Bollinger. Here's where the sells are setting about 77.24. We'll see. You could set a sell at this point if you wanted to. You could set it a little higher. You could set one lower. It's whatever you want. You're up now. Your only choice here is how much money you want to keep making or how much money you might stand to lose if it comes down and does one of the things that Berkshire Hathaway did to me yesterday, which I'll show you. So that was Tech. That was under our 200-day moving average. We ended up $7.69 a share higher on that one from when we put it on the list. UDR did exactly what we needed it to do. We got in, it came up and hit the 200. And then it came back down. Okay. So on UDR with this gap here, you look at a gap saying that thing's probably going to fill. You go up, you set up a limit up here to get out. If it keeps going, okay, so be it. You still got out with a nice profit. UDR was $4.39 a share. So, and then on the paper trade portfolio, this is the value of, I traveled yesterday. This is the value of setting your lower limits. Oops. Put that in front of me. If I can move it. Can't get it over. Yep, can't get it over. There we go. Well, I don't know where my sell limit should have been right here. Yesterday I was leaving. I already had a sell limit in. I put it about halfway through here. I thought it was just going to keep going like the market, but it opened. It started up here, and then it just dropped like a rock, hit through my sell limit. And luckily I did that because it continued to go down. I don't know what went wrong with Berkshire, but you can go back to the minute chart. If I can find it here. Here we go. Oh, that's the month. Oh, hold on. Sorry. 3 month. We'll go to the minute. 1 minute chart. You can see exactly what happened. So at open, you can see we had this big pop up, and then all of a sudden, boom, down we went, down we went. And it went right through my sell limit. I don't have it on here, but it ended up lower than that. So the sell limit was sitting somewhere in this position, and it just kept going lower. And again, that's why we always protect our gains on the bottom side, even if it's a small gain. So I got lucky on that one. But again, most people don't set limits on the lower side and they let them run. And now, if you were in a trade like this and you're saying, okay, I'm below the 9 now. Okay. Do I let it keep running or what? And this is where people, instead of getting out here for a profit, now you're below, and then psychology and your emotions come in. You're like, well, I'm going to stay in, and then it might just keep doing this, and you just keep losing. But these save you all the time when you get in and you put in a limit. That's all I got from my charting. You guys have anything to say? Or I know.
Yeah, can you hear me there, Mark?
Yep.
Yeah, I was traveling down to Toronto. I'm up and down through the rocks in Northern Ontario here, so I might drop out on you, but I just listened to what Bob was saying. And for me, because I'm Canadian and I don't have Fidelity, so my trading parameters are more limited. Like I have stop limits and that kind of thing, but I don't have like your trailing stop losses. I can't do those. So for me, because I'm trading in it's Canadian funds, which the bank transfers over to US dollars, I take a hit on exchange, as well as my trades in and out cost me $10 each way. So I'm not like Paul. Like I can't make 20 cents and make $1.
Right.
So
Yeah, go ahead. I'm sorry.
yeah. So anyway, for me, I'm kind of where Bob is. Like I kind of in the last little while have decided to use the knowledge in the swing trade practices and basically swing trade on my whole stocks, where I can I made $1 on it. So the seller, it's down low. I know it's going to go back up. I just basically follow the net of the
Kind of breaking up, Paul. You must be down in the rocks. You're frozen on us. I think what you're trying to say is you have to use more of a longer term cycle, because you're getting actually charged $10 a trade or whatever it is. So you need to make more on the upside than 20 cents or $1 to make a profit. And that's the way it used to be, not too long ago, when they were, $7 trades or $10 trades or whatever. You had to calculate that in. And so that would be a situation where you'd probably be more prudent to use a longer term, like the 200 or some other type of a longer term indicator to tell you to get in or out. And it would be easier too, because you wouldn't have to monitor it, like swing trading where we monitor it today.
yeah.
Can you hear me? Can you hear me, Paul?
Yeah. I'm
Okay.
back in now.
You're kind of breaking up, but we can hear you a little bit.
Yeah. So what I look a lot at is the slow starch, and
Yep.
And when I see it start to tip, I look at the stock, and if I'm up on it, I'll let it go. I'll sell it. I'll make my profits, and it'll swing down, and then I'll pick it up. When I look at the slow starch and the RSI and see, and I've been having to do it that way. I made well, the last week's been fantastic, obviously, but I made a couple thousand in the last couple of weeks. And,
Awesome.
Wow.
And it's just that those 50-cent trades just kill me, because for me, I've got like by the time they take the exchange and the trade value out, $100 trade is you know is almost like for instance, if you were to buy a stock and it was a $25 stock, and you had to pay you had to buy 100 or 200 shares out of it, just to make $100. That's
Yep.
yeah.
Yeah, you got to look at what your return is going to be and the risk reward on that return, and how much you're investing to get a little bit back, or the potential to lose.
Yeah.
And that's where I think something like what we're talking about, the 200 or longer term, using these indicators. And I wouldn't use the 9 for sure, and I would go more to a weekly or a monthly indicator, and to determine when to get in and out on that situation. But again, we're working on some things, and but right now, just using the 200 would probably help you out immensely if you're going to invest. If you want to invest and not trade that much, to save on your transaction cost.
Yeah, well, just for instance, I followed Kerry. I picked up 1,000 shares of blue. I sold it this morning because I was up 10%. I made $300. So
yep.
If I'm making money, I'll make money. But
Yep.
I'm trying to find the stocks that are solid stocks that I can just follow the momentum up and down on. I know they're going to go up. Companies like Air and PSTG and those ones there, and just like Air's been good this week. It's gone up. It's down a little today. But if it drops too much and I've made the money on it, I'll let it go and I'll pick it up again. When it gets low again. So
yeah, there's a lot of people that just follow maybe less than 10 stocks the whole time, and they just wait and they watch it go up and they watch it go down, and they just do in and out of it. Trent's told us about the people he knows that they trade very little, and they just they're patient. They wait and they trade the good ones. They make a bunch of money, and then they go to the beach.
Yeah. Well, that's kind of where I'm going with the situation I'm in. Like, the swing trading knowledge has really helped a lot as far as deciding when to get it out, look at the Bollingers and follow the momentum and things like that, which I wish I'd known 2 or 3 years ago. I wouldn't have lost so much money, but Google's been really stupid lately. It never followed anything. So
yeah, there's a lot of emotion in some of those Googles and the Teslas, and that people like. I think someone was saying, I think it was Paul or maybe Trent. You get so emotional into that. Like, this is the best stock. I don't care if it goes to zero; it's still the best stock. And Enron is never going to be done. I love Enron. And it goes to zero. And stocks can always go to zero. And don't fall in love with a stock. There's always another one out there that, stocks are there to make you money, not to make you happy.
yeah.
If
Go ahead. I just think with Bob's comment, I think he was thinking more along the lines of what I have to deal with, is that if you're just following the 200 and not following the up and down swing, there's a lot of lost opportunity there.
Yeah.
Well, one thing I've been, and I don't know this for sure, but I just for some reason have been starting to look at it, is when the 9 crosses the 50. When it goes up over the 50, and then when it goes under the 50, and it's pretty interesting. It follows up and it gets you out before it goes too far down.
They call that the golden cross when it goes across. And
really?
whenever a moving average of a smaller number crosses a higher number, that's always called the golden cross, and it's usually a very bullish sign. And vice versa, when it goes the other way, it's
when it goes under,
bearish sign. Yep. So, see, Margaret, I'm going to have Margaret teach next week's class, and Paul and Margaret, and Trent and I we're gonna go fishing.
Right. There you go.
I think Paul should teach.
If you come up where I am, you have to go ice fishing.
Oh, there you go.
No. It's cold enough here today. I'm heading.
Oh man,
It's sunny and 50. I'm going to the barn, guys.
As windy and cloudy as it is here in South Florida, it's still 72 and humid. So we're doing good here because we left 42 degrees and kind of rained. So
It's time to go ride a horse.
time to go have a margarita.
Thank you.
Yeah. You guys
All
have
right.
anything else before we check off here? And anything?
No, but have a good holiday.
Yeah,
All right.
join us for the 3 o'clock Central with Kerry. I'll be on it. I think Mark's gonna be at the bar.
I
So
think it's Tiki Bar down here is what they call it.
is that yeah?
Yeah, we got to tether ourselves to the chair though, because the winds are about 25.
Right.
But we'll make it go.
Oh darn.
Sure,
Yeah.
that's just so you don't fall off the chair.
Well, yeah, that's kind of a bungee that they put on you. Yeah,
Then you blame it on the wind when you do fall off.
absolutely.
Yeah.
See, Jason knows
Yeah.
what we're doing down here.
Yeah. Been there, done that.
Oh, Jan just came in. She went shopping. She bought me a hat. Hold on, guys.
There you go.
Let me see it.
It's 5 o'clock somewhere hat, right?
Oh, it's a
Right.
Miami Beach hat. So see how
Nice.
nice she is.
There you go.
Yeah.
That's
And
a
it's
nice
only
one.
$6.99. She must have went to Walgreens because it wasn't at one of the beach shops right there because they're like 14 or 20 bucks for those hats. So see, she saved me money right there. I can reinvest that savings.
There you go.
She's like your mother. She buys on sales.
Yep, she does. Yeah, that's all she does. And that's what we do here in swing trading. We try to buy on sale and sell it high. And that's what we're trying to do. And I'm glad everyone the light has come on and you're going, wow. And I said the same thing when I started doing this. I'm like, why haven't I been doing this for the last 40 years? And it's because basically no one teaches you this, and you just trust your advisor. And
Well, the thing that makes me so happy is my son is 36, no money sense whatsoever, lives in California, and I've been talking to him about this and telling him set up a Roth and I'll tell you what to do. It will make a difference.
good for you, Margaret. That's good.
Yeah, that's very smart.
Yeah.
Especially, perfect age too.
Yeah.
Yeah.
So next week, trying to put some names together for you guys is going to be tough because everything is just adjusted, and all the moving averages are moving up. So you may be a little slim next week. We'll have to see how the charts look, and I'm not getting back till late Sunday, so it might be a late Sunday for me trying to find you guys some stuff to put on the 200 and the horizon list. But I'll do the best I can.
Well, Mark, the market isn't closed yet, so just give it a couple hours.
I know.
You may have a ton of crap to buy.
Yeah, I'm seeing a lot of red.
Now, see, that's what I like about Trent. He's so positive.
Yeah, right.
Got to balance each other out.
He's just saying what we're
Absolutely.
thinking though too sometimes.
Well, you guys can take care of the rest of that at the 3 o'clock call, and I'll be thinking about you as I'm sitting down somewhere on a windy beach with a margarita.
There you go.
That sounds
All right,
like a
guys.
good plan.
All right.
Okay.
Everybody have a
Mark,
good
have a good
weekend.
one.
Everybody have
Thank
a
you
good
all.
weekend. We'll
Take
see you
care.
next week.
Thank
You
you.
right.
But
Yep. Talk to you later.